Welcome back, everyone, to the deep dive. This time, we're going to be tackling options trading. Specifically, we're going to be looking at this pretty famous book in the field, Options as a Strategic Investment by Lawrence G. McMillan.
Yeah, a classic.
Yeah, and I know you're coming at this, you're coming at options trading sort of with fresh eyes.
Yeah, I have.
No prior experience. So we're going to really make sure that we take this step by step.
Okay.
And break everything down, give you some good examples and some good, just reinforcement
Oh, good.
of these concepts so that this is a deep dive that you can really revisit, multiple times
That's a good idea.
and really master this material.
That's the goal.
Yeah. So this book, it really emphasizes the point that, options trading, a lot of people think that it's very speculative.
Right. Risky business.
Yeah. Very risky.
Yeah.
But this book emphasizes that it can be a powerful tool for strategic investing.
Absolutely.
And so that's really what we want to explore here. So let's just start with the most basic question. What is a stock option?
Okay. So a stock option gives you the right, but not the obligation, to buy or sell a particular stock.
Okay.
At a set price, we call that the strike price.
Gotcha.
And this is within a specific time frame. We call that the expiration date.
Okay.
So it has a deadline.
So it's kind of like, I don't know, almost like having a reservation at a restaurant, but for stocks.
Yeah, that's a good analogy. I like that.
Right.
Yeah, you have the right to that table at that specific time, but you don't have to show up if you change your mind.
Right.
Same with options. You have the right to buy or sell at that strike price, but you don't have to if it's not advantageous to you.
Okay. That makes sense. So now the book talks about two main types of options.
Right?
Can you explain what those are?
Sure. You have call options and put options. A call option gives you the right to buy a stock at the strike price. So if you think a stock's going to go up in price, you might buy a call option. If the stock does go up, you can exercise your option, buy the stock at that lower strike price, and then sell it immediately at the higher market price, making a profit.
So a call option is kind of like betting
Yeah.
that the stock price will increase.
Exactly.
Okay.
And then a put option gives you the right to sell a stock at the strike price.
Okay.
And this would be useful if you think a stock is going to go down in price.
Gotcha.
If your prediction is right, you can buy the stock at the lower market price and then exercise your put option to sell it at the higher strike price, again, making a profit.
All right. So if I think a stock is going up, I buy a call option. If I think it's going down, I buy a put option.
That's right.
But what determines how much these options are actually worth?
Right. Well, there are several key factors that determine an options price. One of the biggest ones is the price of the underlying stock itself.
Okay.
If the stock price goes up, a call option becomes more valuable because you're more likely to profit, from buying it at the strike price and selling it at that market price.
Sure.
Conversely, if the stock price goes down, a put option becomes more valuable.
Okay. Makes sense. So the book also mentions something called the strike price.
Right.
So how does that factor into the value of an option?
So the strike price, relative to the stock's current price, determines whether an option is in the money, out of money, or at the money. Let's just say you have a call option with a strike price of $50. If the stock is currently trading at $60, your option would be in the money.
Okay.
Because you could exercise it, buy the stock at $50, and then immediately sell it for $60, making a $10 profit.
So in the money means you'd make a profit if you exercise the option right now. What about out of the money?
Right. So if that same stock, in our example, was trading at $40,
Sure.
your call option would be out of the money.
Okay.
Because exercising it would result in a loss. You'd be buying at 50 and selling at 40. And of course, at the money just means that the strike price is the same as the current stock price.
Okay, I think I'm getting this. So we have the stock price and the strike price affecting an option's value. What else should we consider?
Well, time is another critical factor.
Oh.
Options have a limited lifespan. They expire.
Right.
And the closer an option gets to its expiration date, the less time value it has. It's kind of like, think of it like an ice cube melting. As time passes, it just gets smaller and smaller.
Yeah.
So this is a concept that we call time decay.
So even if the stock price stays the same, the option could lose value because time is running out.
Exactly. And then the last key factor influencing option prices is volatility.
Volatility. So meaning how much the stock price fluctuates.
Yes, exactly. So the more volatile a stock is, the more expensive its options will be. And this is because there's a greater chance that the stock's price could make a big swing either up or down.
Okay.
And that higher potential for profit or loss is reflected in the options price.
So it's almost like a volatile stock is like a roller coaster.
Yeah, yeah,
Ah.
I like that.
The wilder the ride, the more expensive the ticket is going to be.
That's a good analogy, yeah.
Now,
Okay.
let me see if I can summarize this. We have the underlying stock price, the strike price, time decay, and volatility. All these factors play a role in determining the price of an option. Did I miss anything?
You got it. That's a great summary. You nailed it.
Okay, good.
All the key factors.
All right. So now that we've kind of laid this groundwork, I think we're ready to move on to some actual trading strategies.
Okay, let's do it.
McMillan dedicates a lot of space in this book to covered call writing.
Yeah, a popular one.
Can we unpack what that is and why it's considered sort of like a core strategy?
Yeah, absolutely. So covered call writing is a way to generate income from stocks that you already own.
Okay.
It involves selling call options against those shares.
So instead of just holding onto the stock and hoping it goes up, I'm kind of creating an opportunity to profit in a different way.
Exactly. So let's say you own 100 shares of Apple. With covered call writing, you would sell one call option contract, which represents those 100 shares.
Okay.
And in return for selling this right to buy your shares at a specific price, you receive a premium.
Okay.
And that premium is yours to keep regardless of what happens to the stock price.
So, okay, that sounds interesting, but wouldn't selling a call option mean that someone could buy my Apple shares at a lower price than I want to sell them?
That's a very good question, and it brings us to the risks and rewards of covered calls.
Okay.
So it's true that your profit potential is limited if the stock price rises significantly.
Okay.
If the price goes above the strike price that you set, the buyer of your call option will exercise their right to buy those shares from you at that lower strike price.
Okay.
You'll miss out on some of the potential profit if the stock really skyrockets.
So it's a trade-off. You know, you're limiting potential gains on the upside. What about the downside? What happens if the stock price goes down?
That's where that premium that you received comes in.
Okay.
It acts as a cushion against losses. Okay, think of it this way. Even if the stock price drops, you've already earned that premium.
Right.
So you're reducing your overall losses.
Okay, I see. So it's like a buffer
Yeah.
to kind of soften the blow if the stock takes a dip.
Exactly. And to really understand this risk-reward balance, we need to talk about the break-even point.
Okay.
So this is the stock price at which you neither make nor lose money on the covered call right.
How do we calculate that?
Well, you take the price that you paid for the stock and subtract the premium that you received for selling that call option.
Okay.
So, going back to our Apple example,
Okay.
imagine you bought Apple at $150 a share and you sold a call option for $5 a share. Your break-even point would be $145.
Meaning that if the stock price stays above $145 at expiration, I'm making a profit.
Right.
But if it falls below that, I start incurring losses.
Precisely.
Okay.
Yeah.
Gotcha. Now, what if the stock price, it starts dropping and I'm getting a little nervous about, bigger losses?
Yeah.
McMillan discusses a technique called rolling down,
Right.
which is a risk management strategy.
The risk management strategy, yeah.
Can you explain what that involves?
Yeah, rolling down involves buying back that original call option that you sold
Okay.
and then selling a new one, but this time with a lower strike price.
Okay.
It might seem a little counterintuitive, but it lowers your break-even point
Okay.
and can potentially reduce your losses if that stock continues to fall.
Why does lowering the strike price reduce the break-even point? I'm a little confused about that.
Okay, so think about it this way. When you sell a call option with a lower strike price, you typically receive a smaller premium.
Okay.
Remember, the break-even point is calculated by subtracting that premium from your initial purchase price. So a smaller premium means less to subtract,
Okay.
resulting in a lower break-even point. It's kind of like adjusting your safety net as you descend a mountain.
Okay.
You're lowering it to avoid a bigger fall.
Okay, now that makes sense. So, it's all about strategically adapting, I guess, to the market movements.
Absolutely. And that's the beauty of options trading. You have a range of tools and strategies to navigate, all different kinds of market conditions.
This is a lot to digest, but I appreciate the, step-by-step approach.
Good.
It's definitely making these concepts less intimidating.
That's what we want.
So McMillan also mentions things like expiration dates and cycles. Can you kind of explain what those are?
Yeah, so options contracts, they come with various expiration dates.
Okay.
And they're often organized into cycles.
Okay.
A common one is the January, April, July, October cycle,
Okay.
which means that for a given stock, You can typically find options contracts that expire in those months.
So as an investor, I can choose options with different lifespans based on my strategy. Like if I'm thinking short term, I would go with an option that expires sooner.
Exactly.
And for a longer term outlook, I would choose one that's further out.
That's right.
Okay. What about stock splits? How do stock splits affect my option contracts?
Right, okay. So imagine a company decides to do like a 2-for-1 stock split.
Okay. So for every one share I owned before, now I own two.
Yes, exactly. But what happens to your option contracts? Well, they get adjusted accordingly.
Okay.
So let's say you held an option contract for 100 shares before the split.
Okay.
After the split, that same contract would now represent 200 shares.
Okay.
And the strike price would also be adjusted
Got it.
to reflect that split. So usually it would be halved in that like 2-for-1 scenario.
So even though the numbers change, the overall value of my option contract remains the same.
Precisely. Now, another important concept to understand is margin.
Okay.
The book differentiates between trading options on cash versus margin.
Okay.
So when you trade on cash, you need to have the full purchase price of the option in your account.
Okay.
But with margin, you can borrow funds from your broker to buy options.
So margin allows me to control more options contracts with a smaller upfront investment.
That's right, yeah. It's kind of like leverage.
Okay.
But keep in mind, margin amplifies both potential gains and losses.
Sure.
So you need to be very aware of the risks involved.
Right.
McMillan also briefly touches on portfolio margin, which is more like an advanced method
Okay.
for more experienced traders.
How about that, Graham?
Okay, so unlike traditional margin, which focuses on like individual positions, portfolio margin considers the overall risk of your entire portfolio.
Okay.
So it can potentially reduce your margin requirements,
Okay.
giving you more flexibility. However, it's a complex concept that requires a deep understanding of options and risk management.
So it's something to explore,
Yeah,
maybe as your expertise grows.
right.
So we focus mostly on covered call writing, but McMillan's book covers, a lot of other option strategies.
Oh, yes, absolutely. There's a whole world of strategies beyond covered calls.
Such as?
Well, for example, there are bull spreads, where you're simultaneously buying and selling call options, but with different strike prices.
Okay.
And this strategy allows you to profit from a moderate increase in the underlying stock's price while also limiting your risk.
So it's almost like a more calculated bet on the stock's upward movement.
Exactly.
Right.
And then there are butterfly spreads,
Oh, cool.
which involve buying and selling multiple options contracts
Okay.
at different strike prices. And they create kind of a unique profit loss profile
Okay.
where you profit if the stock price stays within a specific range.
So instead of betting on, a big price swing, you're kind of aiming for stability with butterfly spreads.
Exactly. And then you have ratio rights,
Okay.
where you sell more call options than the number of shares that you own.
Okay.
And this can potentially increase your income, but of course, it also carries a higher risk.
Right.
And finally, there are AAPS, which stands for Long-Term Equity Anticipation Securities.
Wow.
These are options contracts with expiration dates much further out, typically 1 to 2 years.
Okay. So these are much more suitable for investors that have kind of a long-term outlook.
Exactly. They allow you to participate in potential price appreciation over a more extended period. But of course, they come with their own set of considerations.
Wow. So many different strategies to explore.
Yeah.
It's amazing how, versatile options can be. We've covered so much ground today.
Yeah.
Unpacking kind of the essentials of options trading based on McMillan's book.
Right.
Feels like we've only just scratched the surface, though.
We have, but hopefully this is giving you a strong foundation to build upon.
Yeah.
And it's important to remember options trading isn't a one-size-fits-all approach. The best strategy will always depend on your own individual investment goals, your risk tolerance, and your time horizon.
It's really important to remember this is just the beginning, your options trading journey.
Yeah, think of it like learning a new language.
Okay. Yeah.
You start with the basic vocabulary, the grammar, and then you can gradually, build towards more complex sentences, more complex expressions.
And in this case, those sentences are your option strategies.
Precisely.
Huh.
So don't get discouraged if you, don't become an options expert overnight.
Right. Of course.
It takes time, it takes practice, and it takes a willingness to just keep learning and evolving.
Yeah, exactly. And there are, so many resources available out there, whether it's books, websites, online courses, even simulated trading platforms where you can kind of practice. without actually risking real money.
Right. Yeah, that's a good point.
And, remember, you don't have to go it alone.
Right.
Don't be afraid to ask questions.
Yeah.
Maybe connect with other traders, seek guidance from, people who have experience.
Mentors. Yeah, there you go.
The world of options trading might seem a little daunting at first,
It can. Yeah.
but with a little bit of effort and the right resources, you can really unlock its potential
Sure.
and integrate it into your investment strategy.
Absolutely.
So, yeah, this has been, I feel like, we've only just scratched the surface, but this has been a really great conversation.
I agree. It has.
Yeah. And, a lot of really great information for our listeners, whether they're seasoned investors or totally new to the game.
Right.
Options can be a valuable tool.
Yeah, they can be. Yeah.
It's just the key is to, approach them with a strategic mindset, understand those risks and rewards,
Absolutely.
and, just continuously learn.
Keep learning.
Yeah, and refine your approach. So, with that said, this concludes our deep dive into Lawrence G. McMillan's Options as a Strategic Investment. We hope you found it insightful and engaging and, most importantly, a valuable stepping stone on your journey
That's right.
towards mastering options. So, until next time, happy investing.